One person, one call, and yeah, it could rattle the global economy in days. Not some complicated Wall Street scheme, not a cyber attack frying trading servers, just closing a strip of water most people couldn't find on a map. Every day, about 21 million barrels of oil squeeze through the Strait of Hormuz. That's roughly 20% of the world's oil supply. 1 in 5 barrels, all funneled through a passage so narrow, it almost feels like a design flaw. And if you really wanted to disrupt it, you wouldn't need a Hollywood invasion scene. You'd need enough chaos that ships decide it's not worth the risk. That's the fragile part. The system works because everyone assumes that waterway stays open, and assumptions are dangerous things to build trillion-dollar systems on. Now, Iran has threatened this before. It's not new. It's almost routine, but lately, the temperature's different. Regional tensions are simmering, proxy conflicts are flaring up, political leadership has shifted. What used to sound like posturing now sounds plausible. Here's what most people miss. The global economy doesn't just depend on oil flowing through Hormuz. It depends on oil flowing at a predictable price. Predictability is everything. Traders build models around it, companies lock in contracts around it, governments set budgets around it. Take away certainty, and the math starts twitching. Markets don't collapse because something is scarce. They collapse because no one knows how scarce it might become. Right now, the strait staying open is baked into financial models the same way gravity is baked into engineering. It's just there. Nobody debates it until they have to. Let's actually look at how boxed in we are. The Strait of Hormuz is basically the only exit from the Persian Gulf. Imagine 5 oil-rich countries storing their inventory in a room with one door. Saudi Arabia, Iraq, Kuwait, the UAE, Iran. Massive reserves, useless if they can't get out. There are pipelines, sure. Saudi Arabia has one that runs towards the Red Sea, but it's limited, old, not nearly big enough to handle everything. And history shows backups don't always hold. During the 1980s tanker war, they tried to reroute around conflict. Ships were attacked, insurance costs exploded, it got messy fast. And the Suez Canal doesn't help unless oil first passes through Hormuz. So no, that's not a real alternative. Honestly, there isn't a scalable plan B. So what happens if Iran makes the strait effectively unusable? It doesn't even require sinking ships, just enough risk that insurers pull coverage. No insurance, no tanker. No tanker, no movement. Day 1, headlines hit, markets open, oil jumps. Not politely, not gradually. We're talking 30, maybe 40% in hours. Price discovery turns into price chaos. Airlines scramble into emergency meetings. Trucking firms start recalculating margins. Energy futures 3 months out spike because nobody wants to be the last one without protection. Stock markets wobble. Energy stocks surge. Airlines, shipping companies, consumer discretionary, they start bleeding. By evening, statements start rolling out. OPEC Plus promises to stabilize supply. Saudi Arabia hints at raising production. But here's the quiet truth. They're already near capacity. Those statements are more psychological than practical. Day 2 and 3 get heavier. Governments release strategic reserves. The US, Japan, Germany, coordinated action. It helps calm nerves briefly. But reserves are finite. Everyone knows it. You're borrowing from tomorrow to patch today. Then psychology kicks in. Companies raise prices preemptively. Consumers notice fuel costs rising and start filling tanks early. Businesses stockpile inventory. What began as a supply problem morphs into a behavior problem. Fear amplifies scarcity. And here's the part that doesn't make headlines. The real pressure point isn't oil itself. It's derivatives. Hundreds of billions, actually trillions in contracts are built around assumptions of where oil will trade months from now. Pension funds in Germany, insurance firms in Japan, hedge funds in New York, all running models that assume oil sits within a certain range. If oil jumps to 150, 180, those models break. Funds scramble to hedge at the new higher price. That means buying protection when it's already expensive. Losses stack up, margin calls hit. And when margin calls hit, people sell what they can, not what they want. That's how energy shock turns into financial contagion. It wouldn't look exactly like 2008, but the speed, probably faster, because energy is more interconnected now than it was then. Here's where it gets uncomfortable. Markets today might price in a 10–15% chance of serious disruption. It's treated like background noise, an abstract geopolitical risk. But when that 10% flips to reality, the repricing isn't smooth, it's violent. Risk models are backward-looking. They assume the future resembles the past. But a prolonged Hormuz closure, that's not just another stress test scenario.
Look at the Suez blockage in 2021. 6 days, billions in damage. Now imagine 6 weeks in Hormuz. We're not talking billions, we're talking trillions. Not because oil costs more, but because credit freezes when uncertainty gets extreme. Banks hesitate to lend, companies can't secure working capital, supply chains stall because nobody knows what next week's input costs will be. The global economy runs on confidence as much as oil. Block the strait and you block confidence. Zoom out for a second. We've had decades to diversify. Solar, wind, nuclear, batteries, the technology isn't science fiction, it's real. But when oil is flowing and relatively cheap, building redundancy feels optional. So we optimized for efficiency instead. Just-in-time supply chains, concentrated shipping routes, maximum output, minimum slack, which works great until it doesn't. There's an irony here too. Iran would suffer enormously from closing Hormuz. Their own economy depends on oil exports. It would hurt them badly. But brinksmanship doesn't always follow economic logic. Sometimes the threat works precisely because it's self-destructive, like someone threatening to burn down a house they're standing in. Unsettling, right? So what would actually happen if the strait closed? Oil spikes, markets shake, credit tightens, governments intervene. Eventually, either military force reopens it or negotiations diffuse it. The world wouldn't end, but growth would stall, inflation would bite again, asset prices would reset, and the system would carry a scar. Because once you see the fragility, you can't unsee it. And the real question lingers. How long can a $100+ trillion global economy depend on a single choke point, controlled by a region that's never exactly been calm? Say that out loud and the assumption doesn't feel invisible anymore. It feels risky.